With everyone so concerned these days about inflation, on face value it seems like deflation would be a great thing instead. When we have deflation, prices are falling and your money goes a lot further. Sounds like an ideal situation, right? But the truth is, this can be very damaging for the economy as well. So let's start by understanding what deflation is. Deflation is the opposite of inflation. It means there's a decline in the general price levels of goods and services in the economy, not to be confused with disinflation. Disinflation is when prices are still rising, but at a slower rate, whereas deflation is when prices are actually falling. That means deflation would show up as a negative number in inflation data like CPI, the Consumer Price Index. If you don't know what that is, click up here and you can watch a video about it. So if prices in the economy are declining, that means the currency's value in that economy strengthens. That will increase purchasing power, increase real incomes and wealth, and that could lead to more spending, which will help to boost economic growth. So if deflation can help economic growth, why do central banks prefer inflation instead? Although deflation could lead to an increase in economic growth, it could also have the opposite effect as well. Like for example, when the price of goods and services decline, consumers may delay their purchases because they hope they're going to become cheaper in the future. So lower consumer spending contributes to lower economic growth. Another important reason for avoiding deflation is that it increases the real value of debt, and it could make it harder to repay. So for example, if a business takes out a loan to expand the business, but then prices continue to fall, it may not make enough money to maintain its repayments. That could increase the risk of defaults on debt and could make getting a loan in the first place much more difficult. Deflation also leads to lower profits for businesses because they'll need to lower prices to remain competitive, and this could result in less expansion, less hiring, which could suppress wages and again lead to lower consumer spending. Now eventually businesses may be forced to lay off workers to maintain margins, therefore leading to increased unemployment. So lower consumer spending, which leads to lower profits and more job losses, leads to lower consumer spending again, and you can see how this has potential to become a vicious cycle that nobody wants. However, a study from 2015 by the BIS found that the link between economic growth and deflation is actually quite weak, with the Great Depression being the main exception. The study suggests that the main problems from deflation come from a sharp fall in asset prices, particularly housing prices, which erodes wealth and can lead to banking distress, not so much from the falling prices of goods and services. But where does deflation even come from? Deflation is often associated with a decline in demand that pushes down prices, incomes, and output. But although this is often the case, deflation can also come from oversupply. The same study from the BIS gave some examples of improvements in productivity, greater competition in the goods market, or cheaper and more abundant inputs such as labour or intermediate goods like oil. They went on to say that supply-driven deflation depresses prices while raising incomes and outputs. So in this scenario, deflation may actually have those positive effects on economic growth which we mentioned at the start. However, the threat of Depression-era deflation is a genuine concern, as debt-to-GDP levels tend to be very high. So due to those risks, central banks usually target a positive inflation rate, usually around the 2% mark for developed countries, and if the economy went into deflation, they would likely make decisions that would stimulate economic growth. For example, the first decision a central bank might take is to lower interest rates to encourage more borrowing and more spending. However, as we mentioned earlier, if the real value of debt is increasing, consumers and businesses may find it difficult to take on more of it. So that means the central bank could be forced to take more extreme actions, and one could be quantitative easing to increase the money supply, therefore encouraging banks to lend more and lowering interest rates to encourage more borrowing. So overall then, maintaining a low and stable inflation rate is an important goal for central banks to avoid the risks that come from deflation, even if in some cases it could have positive benefits for the economy. In this situation, the benefits just don't outweigh the risks.